Did you know that with just two stocks and a modest investment, you could potentially pave your way to wealth in 2024? Yes, you heard that right. Only two stocks. Today, we're diving into the investing world, guided by none other than Charlie Munger, the legendary investment guru. Known for his wisdom and successful strategies, Munger has a track record that turns heads in finance. But what's truly astonishing is his simple yet powerful approach to building wealth, which might just change your perspective on investing. So, in today's video, we're going to explore Munger's unique insights on how selecting just a couple of stocks, and not a whole portfolio, could be the key to growing your wealth in 2024. But the burning question remains, which two stocks are we talking about, and how can a simple strategy be so effective? Without further ado, let's get started.
I would argue that if I were investing money for some sovereign wealth fund or some pension fund, and a 30, 40, 50-year time horizon, I would buy Costco at the current price.
Let's dive into a story that sounds like it's straight out of a business thriller. The year is 1997, and Costco, already a juggernaut in the retail world, offers Warren Buffett a seat on its board. But plot twist, Buffett says no thanks and throws the ball in Charlie Munger's court instead. And Munger? He grabs it with both hands. Now, this isn't just a story of a board appointment. It's about a bond formed over decades. Munger wasn't just a board member at Costco. He was its cheerleader, its staunch supporter. And let's not forget, a self-proclaimed total addict. His faith in Costco wasn't just talk. He put his money where his mouth was, owning a staggering 187,180 shares, valued today at a jaw-dropping $110 million. Talk about betting on the right horse. But here's where it gets even more exciting.
I wish everything else in America is working as well as Costco does.
Costco isn't just a retail player. It's the world's third largest, right behind the giants Walmart and Amazon. And it's not just big, it's unique, with a whopping 870 stores in 14 countries. Costco is a global phenomenon, breaking barriers and winning hearts. Remember when they opened their first store in France? A notoriously tough market for outsiders. They just didn't succeed, they triumphed, with plans to expand even further. And just when you thought it couldn't get any better, Costco decided to up the ante in 2023 by stepping into China, opening not one but 5 stores. They're not just expanding, they're exploding on the global scene. Now, hold on to your seats for this. Costco's dropping a massive financial bombshell, a special cash dividend of $15 per share in January 2024, the biggest they've ever announced. We're talking about a total payout of $6.7 billion to shareholders. This move is the cherry on top of an already booming stock value, which has shot up nearly 40% this year. But wait, there's more. Costco's fiscal first quarter earnings? They didn't just meet expectations, they crushed them, with revenue soaring to $57.8 billion and earnings per share jumping by 17%. These numbers aren't just impressive, they clearly signal Costco's unstoppable growth and Munger's undeniable business acumen. So what's the secret to Costco's success? How does a company make a profit before even selling a single item? First, in fiscal 2022, Costco's net sales hit an eye-watering $222.7 billion, jumping a whopping 16% from the year before. But here's where it gets interesting. Their gross margin? Only 12.05%, way lower than many traditional retailers. Walmart, for instance, boasted a margin of 24.4%. So what's Costco's trick? The answer lies in their unique approach. Unlike other retailers, Costco charges its members an annual fee just to shop in the stores. In 2022 alone, these fees racked up a staggering $4.2 billion, forming a massive chunk of their operating profit. And let's not forget their total gross profit, a cool $27.6 billion. Now for the big question, why do people happily pay these fees? It's all about value and exclusivity. With low prices and a high average household income of nearly $93,000 among its members, Costco enjoys a sky-high retention rate of over 91.3%. This isn't just a business model, it's a loyalty engine. And guess what? They don't even need traditional advertising. While competitors like Walmart spend billions on marketing, Costco spends virtually nothing. No flashy ads, just targeted mailers and coupons. Simple yet effective. But how on earth does Costco manage to skip traditional advertising altogether? It sounds like a marketing taboo, right? But here's the deal. They've got a couple of secret weapons up their sleeve. First, Costco's products are like that friend who's effortlessly cool. They just sell themselves. The whole membership model is a stroke of genius. You can access incredible deals that regular retailers can't even dream of matching. It's like being in an exclusive club where the price of admission pays off big time for those who shop there often. Now, the second reason is a bit more strategic. You might think, why not just market like crazy to get people through the doors more often? But here's the kicker. Doing that wouldn't really move the needle for Costco's bottom line. Why? Because the real moneymaker for Costco isn't the sales, it's those membership fees. They're like the golden eggs. Spending a fortune on ads to attract more members just doesn't add up when the current strategy works like a charm. Another game changer that adds to Costco's success is its employees. Costco's staff are not just workers, but the backbone of the company's success. Each member generates nearly triple the revenue compared to those at Walmart and Target. Why? Because Costco invests in them, offering higher wages and a great work environment. This means happy employees and, in turn, satisfied customers. And sure, like any retail giant, Costco faces its share of economic challenges, but their track record of reliability and solid revenue growth makes them more than just a retailer. They're a testament to smart business practices. Moreover, despite Munger's traditional value investing approach, he recognizes the significance of Costco maintaining a strong online presence.
Costco is going to be an absolute titan on the internet because they got curated products that everybody trusts and huge purchasing power on a limited number of stocking units.
Now, have you heard of the Magnificent Seven of the stock market? No? It's not a Western film. It's something even more exciting. Let's explore how Alphabet, Google's parent company, leads this extraordinary group of tech giants. In 2013, CNBC analyst Jim Cramer coined FANG, Facebook, Amazon, Netflix, Google, to describe the top tech stocks. Add Apple in 2017 and you got FANG. But now there's a new game in town, the Magnificent Seven, as dubbed by Bank of America analyst Michael Hartnett. This elite group, including tech behemoths like Nvidia, Tesla, and Microsoft, is redefining the market. So, what makes Alphabet stand out among these titans? Alphabet's price-to-earnings growth ratio is an impressive 1.39, indicating it's a value buy. With an enterprise value to EBITDA of 13.42% and a striking 27.57% three-year CAGR in earnings per share growth, Alphabet isn't just playing the game, it's dominating it. Since its IPO in 2004, Alphabet's shares have skyrocketed. We're talking a jaw-dropping increase of 5,360%. To put that into perspective, the NASDAQ Composite Index, a pretty decent benchmark, only went up by 681% in the same period. But hey, we're not just here to look at the rearview mirror. The real excitement lies in what's ahead for Alphabet. Now, let's unpack the secret ingredients of Alphabet's success recipe. First off, we've got something called the economic moat. Sounds medieval, right? But it's actually a term from investing legend Warren Buffett. It's all about having a robust and unique business model, so all those would-be competitors can't breach the castle walls. And boy, does Alphabet have a moat. The crown jewel of Alphabet's empire? Google Search. It's not just any old search engine. It's a colossal ecosystem connecting folks like us, content creators, and advertisers. It's like a snowball rolling down a hill, getting bigger and bigger as more people join in. And its market share? A whopping 92%. That's not just leading the pack, it's owning the race. But wait, there's more. Alphabet's secret weapon is its data, mountains and mountains of it. It's like a treasure trove that keeps on giving. Think about it. Alphabet's not just raking in cash from the good old US of A. They've gone global, spreading their wings all over the world. This isn't just about reaching more people, it's about creating a safety net of diverse income streams. It's like not putting all your eggs in one basket, but instead having baskets all over the globe. But there's more to their diversity story. It's not just about where the money comes from, but how it comes in. Sure, advertising is their bread and butter, but Alphabet isn't just sitting back on those laurels. They're like a tech wizard, constantly pulling new rabbits out of the hat. Enter Google Cloud, YouTube, and a whole array of Google Other ventures. Each adds a unique flavor to their revenue pie, making it tastier and more resilient. When it comes to numbers, they impress. Alphabet's gross margin stands at a healthy 56.7% and its operating margin at 28%. Unlike many growth-focused tech companies that sacrifice profit for expansion, Alphabet balances both, boasting $78 billion in cumulative free cash flow over the past 4 quarters. And the balance sheet? It's like a financial pillow, soft and reassuring. With a modest $13.8 billion in long-term debt against a whopping $119.9 billion in cash and securities, Alphabet is well cushioned against any economic downturns. This financial strength means Alphabet isn't just surviving, it's thriving, continuously investing in new ventures like artificial intelligence to bolster its competitive edge. And there you have it, a deep dive into Charlie Munger's simple yet powerful strategy for wealth building in 2024 with just 2 stocks. Now, if you had to choose one of these 2 stocks to invest in for the next year, which one would it be and why? Comment down below, and thanks for watching.